You've been renting for 6 years. Every year, someone tells you the same thing. You're just throwing your money away. But here's what nobody shows you. The math is not that simple. Not even close. Picture this. You're 32 years old. You've got $40,000 saved up. You're standing at a fork in the road. Path 1, buy a house. Path 2, keep renting and invest the difference instead. Almost everyone assumes path 1 wins automatically. Today, you're going to see the real numbers behind that assumption. Let's start with what a home actually costs you right now. The median home in America sits at $440,600. That's according to the National Association of Realtors. Their chief economist, Dr. Lawrence Yun, says prices just hit an all-time high. Now add the mortgage on top of that price. The average 30-year fixed rate is running around 6.49%, according to Freddie Mac. Before we go further, let's quickly understand what that rate actually means. An interest rate is the price you pay to borrow money. The bank isn't lending you $400,000 out of kindness. They're charging you for the privilege every single month. At 6.49% over 30 years, you pay back more than double what you borrowed. That's not a scare tactic. That's simply how amortization works. Amortization is the schedule that spreads your loan payments out over time. In the early years, almost all of your payment goes toward interest. Barely any of it goes toward actual ownership. Most first-time buyers have no idea this is happening. They assume year 1 and year 20 build equity the same way. They don't. Not even close. Now, picture your actual monthly payment. On a $400,000 loan at 6.49%, you're looking at roughly $2,527 a month. And that's before property tax, before homeowners insurance, before maintenance and repairs. Add those in, and your real monthly cost often runs 20 to 30% higher. There's one more line item most first-time buyers forget entirely. If your down payment is under 20%, lenders usually require PMI. PMI stands for Private Mortgage Insurance. It protects the bank, not you, in case you stop paying. It can add another $100 to $200 to your monthly bill. Your credit score decides a lot of this too. A credit score is a number that tells lenders how reliably you repay debt. A higher score gets you a lower rate, a lower payment, and often no PMI at all. Meanwhile, the median asking rent in America right now sits close to $1,850 a month according to Zillow's research data. Sit with that gap for a second. That's real money, every single month. Money that could be going somewhere else entirely. Here's where most people stop the math cold. They compare rent to a mortgage payment and call it a day. But that's not the full story. Not even close. You have to account for something economists call opportunity cost. Opportunity cost is what you give up by choosing one option over another. If you buy, your $40,000 down payment gets locked inside the house. If you rent, that same $40,000 could sit in an index fund instead. An index fund is a basket of stocks that tracks the whole market, like the S&P 500. Companies like Vanguard built entire business models around low-cost versions of these funds. Historically, the U.S. stock market has returned around 7% a year after inflation. Housing, over the long run, has returned far less than most people assume. Yale economist Robert Shiller helped build the Case-Shiller Home Price Index. He spent decades showing that home prices barely beat inflation over most of American history. That surprises almost everyone who hears it for the first time. We're taught a house is the best investment you'll ever make. The long-run data tells a much quieter story. So why does buying still feel like the obviously smart move? This is where money psychology comes in. Humans are wired for something called loss aversion. Loss aversion means losses hurt roughly twice as much as equivalent gains feel good. Rent feels like a loss because you never see that money again. A mortgage payment feels like a win because part of it becomes equity. But your brain quietly ignores the interest you're losing. It ignores the maintenance costs. It ignores the opportunity cost sitting inside your down payment. Your brain is doing bad math and it doesn't even realize it. Let's bring in a real example with real numbers. Imagine choosing between a $2,527 mortgage payment and $1,850 in rent. That's a $677 difference every single month. Invest that difference in a simple index fund instead. Over 10 years, at a 7% average return, that grows to roughly $117,000. Now compare that to the equity in the house. On a $400,000 loan at 6.49%, after 10 years, you've paid down only about $61,000 of principal. Home prices might appreciate on top of that number, but stock prices grew on top of the investment too. This is the comparison nobody puts on screen. It was never rent versus buy. It's always rent plus invest versus buy. There's a rule some financial analysts use to sanity check this decision. It's sometimes called the 5% rule. Take the home price, multiply by 5%, then divide by 12. That gives you a rough monthly cost of ownership. It covers maintenance, property tax, and the opportunity cost of your down payment. On a $440,600 home, that works out to about $1,836 a month. Compare that number to local rent for a similar home. If rent runs meaningfully lower than that number, renting may come out ahead. If rent sits close to or above that number, buying may make more sense. This is not personalized advice for your specific situation. It's simply a framework many financial educators use to think it through. Your own numbers depend on your city, your timeline, your credit, and your goals. A licensed financial professional can run your actual numbers with you. Now, let's talk about the biggest variable nobody prices in, time. This entire comparison flips depending on how long you stay. Closing costs alone typically run 2 to 5% of the home price. On a $440,600 home, that can be over $17,000 gone before you even move in. Sell within 3 or 4 years, and those costs can wipe out any equity gain completely. Stay for 15 years, and the math often tilts hard toward owning. That's because your fixed mortgage payment stays flat while rent keeps climbing. Rent has no ceiling. Your landlord can raise it every single year and often does. A fixed rate mortgage locks your core housing cost in place for decades. That's the real trade being made here. Renting buys you flexibility. Owning buys you a hedge against future rent increases. Neither one is universally correct. Here's a detail that surprises most viewers. According to Redfin, the typical American homeowner now stays put for 12 years. That's nearly double the tenure homeowners had back in 2005. Longer tenure changes the math a lot in the owner's favor. Shorter tenure flips it hard toward renting. Would you know right now which one describes you? Think about two people living almost the same life. One rents an apartment in Austin, Texas. One buys a similar home in that same city. The renter gets a great new job offer 2 states away. She moves in 3 weeks flat, no realtor fees, no repairs, no penalty. The owner gets that exact same job offer, but selling costs him tens of thousands of dollars in fees and repairs. He hesitates. He stays in a job that isn't right for him just to protect his house. This happens to real people every single year, all over the country. Housing economists call this reduced labor mobility. It's one of the quiet costs of ownership that never makes it into the brochure. Before we move on, let's quickly define one more term. Net worth is everything you own minus everything you owe. Home equity counts toward net worth, but it's not spendable cash. You can't use it to pay for groceries or a car repair. Economists call that being asset rich, cash poor. It's why some homeowners look wealthy on paper, but feel broke month to month. A stock portfolio doesn't have that same problem. You can sell a slice of an index fund in seconds, any day the market is open. Selling a slice of your living room is not an option. That liquidity gap matters more than most people realize going in. There's another piece of psychology working against buyers here: status spending. A house often signals something bigger than shelter, stability, success, folks. Making it that pressure pushes people to stretch their budget past what the math supports. The Consumer Financial Protection Bureau has repeatedly warned about this exact trap. Being house poor is one of the most common financial traps in America. House poor means most of your income goes toward housing. That leaves little left over for savings or emergencies. It's a quiet kind of financial stress that looks completely fine from the outside. Nobody posts their mortgage statement on social media. So, what actually matters when you're the one deciding? Your timeline matters the most out of everything on this list. If you're staying put for a decade or longer, ownership often wins. Your local rent to price ratio matters just as much. Some cities favor renting hard, others favor buying hard. Your emergency fund matters too. Owning means you're the one paying for a broken water heater, not a landlord. And your own risk tolerance matters more than any spreadsheet. Some people sleep better with a fixed payment locked in for good. Some people sleep better keeping their options wide open. There's no universally correct answer buried in here. There's only the right answer for your specific life right now. Here's the part that matters more than any single number. This decision was never really about a house. It's about what you're actually optimizing for. Freedom to move when opportunity calls. Stability to plant roots and settle in. Growth through the stock market. Growth through your own home equity. Every single path here can build real wealth over time. The version that fails you is the one you back into without ever running the numbers. So, before you sign anything, run your own comparison first. Check your local rent to price ratio for your actual city. Factor in your down payment's opportunity cost. Honestly, factor in how long you'll realistically stay in one place. And talk to a licensed financial professional who can look at your full picture, not just a national average pulled from a headline. Because the real wealth building move was never renting or buying. It was understanding the math well enough to choose on purpose. If this changed how you think about your next move, hit like. Drop a comment with your city's rent to price ratio. And subscribe for more of the money math nobody shows you.